How's it going, everyone? Brian Hoops here with Midwest Market Solutions. This is our latest internet video series. It is Tuesday, October the 13th, and of course, we welcome you here and thank you for joining us in our latest internet series. We've had a lot of things going on and have not been able to get on and publish our internet video series as often as we would like, but we do thank you for your time and willingness to visit with us. And if you ever have any questions, please feel free to reach out to any of our offices. As you can see, since our last update, we've added two new branch offices, an office in Verona, North Dakota, as well as a branch office in Thief River Falls, Minnesota. So we welcome Christy and Jody to our family, and very excited to continue to serve our clients in major market states such as North Dakota and Minnesota, our office in South Dakota, a couple offices in Iowa and in Missouri as well. So a lot of opportunities, a lot of options for you if you're a producer in one of these areas and want to visit with us. Just stop in or call any of our local offices. As a reminder, the risk of loss in trading futures and options is substantial, and each investor must consider whether this is a suitable investment for them. Past performance, whether actual or indicated by simulated historical results, is not indicative of future results, and the trading advice we give is taken from sources we believe are reliable. We can't guarantee the information is accurate or complete, and it should not be relied upon as such. Everything is copyright 2015 by Midwest Market Solutions, and our advice is our good faith judgment at a specific time, and that can change without notice. And reminder, there's no guarantee that what we talk about here will result in profitable trades. Now, we will certainly do our best to bring you those profitable trading markets and opportunities, but we wish we could guarantee that, but of course we can't. I'm not able to do that. Let's go ahead and look at our marketing strategies here. First, strategy number one, we're looking at selling cash as our number one strategy. This is a very easy strategy. That's one of the major advantages. There's no downside risk in here. As we know, our exact risk will be we have no upside potential. For example, our harvest cash price for corn is $3.50. That's today's price. Our price is $3.50 as well. So when you make your cash sale at harvest, that is your price, whatever it is today. No upside, no downside. You don't have to worry about what prices do in January, February, or even into the spring or summer, because you've made your sale and your price is noted as what it is. So it's a very simple strategy. Now, but let's look at strategy number two. Okay, this is where we place our crop in storage. Now, we have unprotected, meaning that we don't have anything in place other than we're just placing the crop in storage, anticipating or hoping for higher prices down the road. It's an easy strategy, and it gives us upside potential because we have not sold the crop. But that also means we have unlimited downside risk. If we own the crop yet, prices go cheaper, we get a cheaper price, plus we're paying storage. If we are right and prices move higher, that's good for us, and we have unlimited potential. So for example, our price today is $3.50. Prices move lower to $2.50 by February. Our price is $2.50. If prices move higher to $3.25, our price is $3.25. Pretty simple, easy to use strategy. Let's move on to number three, where we buy put options while placing the crop in storage. This is very easy strategy as well. What it gives us here is unlimited upside potentials. We retain ownership of the crop, but we have downside risk is eliminated because of the ownership of the options here. And those options are put options protecting the downside. The disadvantage is the cost of the option premium that we pay. That's the one-time cost that we're going to pay for this, and that's our only disadvantage. So this is a good strategy to use. If our price is $3.50 today, we're going to look to buy put options that cost us 20 cents. That way we're guaranteed for lower prices moving through the winter. If prices move to $2.50 by February, we're guaranteed that $3.50 minus the cost of our option, so we get a net of $3.30. If prices move higher by February, we have guaranteed ourselves worst case price of $3.50. but we have unlimited upside because we retain ownership. So now prices are $4 by February. Our price becomes $4 less that 20-cent cost of the option, so a net of 380. So this is a great strategy as it protects the risk on the downside but leaves the upside wide open. Meanwhile, we take advantage of maybe some storage and some carry in the market, and it is just a good overall strategy because we retain ownership of the crop and we protect our downside risk in this particular strategy. As we look at this example, the cost of the option is the net premium. That's 20 cents, and that is a one-time charge. When you buy an option, you're paying 20 cents as a maximum out-of-cost strategy here, and that is not an overly expensive price. So it is a very worthwhile marketing tool to use as far as buying puts. Now, something else we can do is we can sell call options, and this means we're put the crop in storage, we're selling call options. We're going to do this when we don't believe the market has a chance to go sharply higher. Maybe a little bit higher or sideways is the ideal strategy to use this in. Maybe a market that we don't feel there's much downside risk. This is a pretty easy strategy as well. We retain ownership of the crop. Disadvantage here, possible margin calls on short options. The downside risk only minimized to option premium, while our upside is capped by the option strike price. So maybe a little confusing. Let's talk about some strategies here. Let's say our cash price for corn today, $2.85. We're going to sell a July out of the money call, a $4 strike price, and we're going to collect 10 cents. When we sell an option, we're collecting that money. As prices move lower to 225 by July, we don't have any downside protection because we didn't buy a put. So we get the 225 to sell at, but we do keep the 10 cents we sold the option for, so we get 235. What if prices move higher by $4 by July? It's a good strategy because we get the $4 higher, we get the $4 prices, plus we get to keep the 10-cent option premium, so now we've got 410. If prices were, say, let's say $3, we would sell for $3 plus the 10 cents because we keep the 10-cent option. The only time we wouldn't keep the option premium is if things move to maybe 450. Now we have sold a $4 call. We have 50 cents. The option's worth 50 cents. We sold it for 10. We have to buy it back for 50. So we've lost 40 cents on that. The 450 is what we sell our cash price minus the 40 cents, and we end up with 410. Let's combine these strategies and talk about our grain strategy number 5. This is where we buy puts and sell calls. So we're retaining ownership of the crop through this strategy. We do have possible margin calls on the short options. Anytime you sell an option, let's say we sell it for 10 cents, if we sell it for 10 and it becomes worth 20, we do have to pay that extra 10 cents. That's a margin call. Downside risk is protected in this strategy because we've bought put options, as well as our upside is capped by the option strike price. Our harvest price for corn is $3.50. We're selling July out of the money calls at $4 strikes, and we're buying July 340 puts for 20 cents. So we're putting a window or a fence in here of between $3.40 and $4 for July corn. If prices move to $2.50, we get $3.30 because we guaranteed ourselves at least $3.40. And we spent 10 cents to do that. Remember, we bought puts for 20, sold calls for 10, so that's a net of 10 cents. So our price is $3.30. What if prices move higher? Well, we've guaranteed a worst case price of $3.40. If it goes to $4, we get the $4 price at our elevator. But what did we spend for the option? Well, in this case, we spent 10 cents. So we spend 10 cents. Prices are $4, so we actually get a net of $3.90 because of our 10-cent loss on the option premium. What if we go to $4.50? Well, we spent 10 cents on the option. We get to $4.50, but we've lost about 40 cents on the spread. So we would end up with a net price of $4.10. So good strategy here as we buy puts and sell calls, and that gives us upside potential, protects us on the downside, and we retain ownership through this strategy because we're putting crop in storage. Let's look at another strategy where we have the crop in storage, but we're selling the crop. So that means we're selling the carry means a couple different things here. We've really basically given up ownership, and we'll transfer that ownership in July if that's the month that we sell our carry in. And let's use that as our example. So we take advantage of higher prices offered in deferred contracts, and there's no downside risk because we've established our price. A lot of times markets will have a carry or a premium built into the market. Maybe it's 10, 20, 30 cents, depending on how long you're going to place the crop in storage. The market does that as an incentive for farmers to store the crop for them, and you'll be rewarded. Sometimes it's 10, 20, 30 cents, depending on how long you hold the crop for. There's no upside potential because you've sold the crop. And in our example here, the price is $3.50 today, $3.75 in July. We're going to sell it at $3.75, so that's our price. If prices move to $2.50 by July, our price is still $3.75. If they move to $4 by July, our price is still $3.75. So in this case, prices have moved higher. We get the $3.75. There's no upside potential. There's no downside risk, making it a very easy marketing strategy. And you can do this strategy through your broker, such as ourselves. You can do it through your elevator, most likely on a forward contract. But it's a good strategy to look at if there's carry offered in the market, which there is in the corn market this year, and there's a good chance that prices may not rally to that level by July if things don't improve as far as export pace or that sort of thing. All right, let's combine a couple strategies here for our last strategy, number 7. This is where we store the crop, we sell the carry, and we buy calls. Okay, so in this strategy, we take advantage of higher prices offered in the deferred contracts. That's where we sell the carry. There's no downside risk because we've sold for the carry, and we have upside potential through the calls. The only disadvantage is the cost of the option. Let's go through an example. Our harvest cash price for corn is $3.50. We're selling for July at $3.75, and we buy July 380 calls at 20 cents. That would be approximately the cost of storage. Your price, worst case scenario, is $3.55. We get that from the $3.75 you sold at minus the cost of the options. $3.55 is your worst case price. If prices move lower by July, say to $2.50, you get that $3.55 we discussed. But what happens if prices move higher? They go to $4 by July. You get $3.75. That's what you sold at. Remember, you spent 20 cents to do that, so that's $3.55. But your call option has gained 20 cents, and that is because it's a $3.80 call, and the prices are at $4. There's a 20-cent difference there, or meaning your July option is worth 20 cents now. And so you add that back in, you get to $3.75. What if prices go to $4.50 instead of $4? Well, now your option, instead of being worth 20 cents, is worth 75 cents. So your price, instead of being $3.75, is worth $4.25. Okay, so you sold at $3.75. But your option is worth an extra 75 cents, so now you get $3.75. So, $4.50. So you get the advantage to the upside. The $4.50 less the 20-cent premium of the option gives you a net of $4.30. So you get a lot of the upside potential through that. You lock in worst case price, have some upside potential. I think this is a good strategy, especially on a market like this year where, yes, there is maybe some upside potential as we get into the spring months, into the summer, where maybe a drought or something can happen. Plus, we have the upside covered and the downside risk taken out by selling the carry. All right, we're going to sign off here. But again, thanks for joining us. Contact any of our offices to get your account open with us. Let us help you more effectively market your grain and your livestock. We have 6 offices around the country to serve you. Let us know how we can help. This has been Brian Hoops from Midwest Market Solutions and our website, MidwestMarketSolutions.com. Till next time, have a great day, everybody, and good luck on your tradings. Have a safe harvest. We'll talk to you again soon.